Breaking news. The financial system just flipped the script. Gold at $5,000, Bitcoin at $150,000. This isn't a rally, it's a structural earthquake. Forget the headlines, we're in a liquidity supernova. What exactly detonated this unprecedented move? The trigger is simple and terrifying. The Federal Reserve, in a desperate bid to stave off a global growth recession, has initiated an aggressive, massive rate-cutting cycle. This isn't the mild, data-dependent cut. This is a panic pivot, driving real interest rates deep into negative territory. The immediate, inevitable consequence? The cost of capital has collapsed, flooding the world with cheap money. Global liquidity, the lifeblood of risk assets, is overflowing. This unprecedented injection of capital, coupled with the erosion of savings via inflation, has forced institutional and retail money alike into the only two safe havens that offer a tangible shield and exponential upside: gold and Bitcoin. For gold, it's the central banks who are the relentless buyers, viewing the $5,000 price point not as a peak, but as the new baseline for monetary stability in a world of fiat currency debasement. For Bitcoin, the recent surge in ETF demand has acted as a hyper-accelerant, bridging the gap between skeptical institutions and this disruptive digital asset. The current phase is pure, unadulterated FOMO. We are not just witnessing price appreciation, we are watching a fundamental repricing of risk and value. This is the endgame for the risk-free rate. When your bond yield is negative in real terms, holding cash is a guaranteed loss. The money has to go somewhere, and it's flowing directly into the most scarce, decentralized, and historically resilient assets. The warning: don't be fooled by the volatility. The weak hands and the latecomers will be shaken out. The $150,000 print on Bitcoin, while spectacular, will include brutal pullbacks and flash crashes. You must zoom out. This is a multi-year trend driven by balance sheet expansion, not a day trader's fantasy. The edge. You must think of these two assets not as competitors, but as the two blades of a hedging and growth strategy. Gold is your rock-solid foundation, the defense against policy error and systemic collapse. It's the ultimate hedge against inflation and geopolitical chaos. Bitcoin is your strategic offense, the asymmetrical growth play that benefits most from the low-rate, high-liquidity environment and the technological shift towards decentralization. Investors who are sitting on the sidelines, waiting for a safer entry point, are making the single biggest mistake of this cycle: confusing prudence with paralyzing inaction. The risk of being completely out of these two assets is now statistically higher than the risk of a temporary 30% correction. This is a moment of profound wealth transfer. The time for analysis paralysis is over. You must rebalance your portfolio now to aggressively capture this opportunity. Allocate, establish a strong, foundational core position in gold. This is your anchor. It validates the inflation thesis. Exploit. Use the growth engine of Bitcoin for asymmetric returns. The current flow dynamics, driven by institutional ETFs, suggest the $150,000 is merely a pit stop towards the next psychological barrier. The final word: do not wait for a perfect dip that may never come. Embrace the volatility, build your positions, and hold for the macro shift. This is not a drill. This is the moment to earn generational wealth, but only if you move decisively. The world is awash in cheap money. Are you positioned to profit from it, or will you let it pass you by?